Welcome back to the Financial Archives. In today's episode, we're exploring the savings and loan collapse, one of the biggest banking disasters in American history during the 1980s and early 1990s. Savings and loan associations, often called thrifts, were specialized financial institutions mainly created to help ordinary Americans secure affordable home loan. Unlike traditional commercial banks, these institutions operated under different regulations and were expected to keep a large share of their investments tied to residential mortgages. The collapse was caused by several major factors, including rising interest rates, financial deregulation, and widespread corruption across the industry. During the 1980s, the Federal Reserve, the central banking system of the United States, aggressively raised interest rates in an attempt to slow down inflation. Those higher rates increased borrowing costs for thrift institutions, placing enormous pressure on their earnings and weakening many firms financially. At the same time, savings and loan companies were dealing with growing competition from commercial banks and other lenders, leaving many unable to survive under the changing market conditions. In an effort to stay profitable, some institutions started approving far riskier loans, including adjustable-rate mortgages and low-quality lending agreements that carried greater danger for borrowers. Many of those risky investments generated short-term profits, but also exposed the institutions to severe financial losses once borrowers began defaulting. The crisis became even worse because of fraudulent behavior, with certain executives involved in dishonest lending schemes and the misuse of depositor funds. As a result, hundreds of thrift institutions eventually collapsed, triggering one of the largest waves of financial failures in modern American history. The government response proved extremely costly, with federal authorities spending more than $124 billion to rescue failing savings and loan institutions. Much of that financial burden was ultimately transferred to taxpayers through industry fees and government-backed recovery programs. The economic damage was severe, with countless Americans losing homes, personal savings, and confidence in the financial system itself. The disaster also pushed lawmakers toward tougher banking regulations and increased oversight designed to strengthen consumer protection. The savings and loan collapse became a defining moment in U.S. financial history, forcing the government to intervene in order to prevent wider economic instability. The aftermath led to major reforms throughout the banking sector, along with stricter supervision intended to reduce future financial risks. Today, the savings and loan crisis remains an important lesson about financial responsibility, proper oversight, and the dangers of unchecked risk-taking within the banking industry. Thank you for watching this episode. Be sure to subscribe to the channel and activate the notification bell so you never miss our upcoming financial documentaries.